All right, June's Consumer Price Index report will be released, and it's expected to reveal more details on inflation and the state of the U.S. economy. June's Consumer Price Index report is set to be released today. Economists say that it may show an even hotter month than May. So here to break down what all of this means is Tom Essay. He is the president of Sevens Report Research, a financial research firm that navigates today's stock market. I'm glad you are here because I barely understand any of this. I just know that it's costing me a little more to get the stuff that I want. June's Consumer Price Index is expected to be released today. Do we expect to see rising inflation, and how significant would a rise in inflation be at this moment?
Anne-Marie, thank you very much for having me on. And you understand plenty then if you understand how much it impacts your life and everyone's life. And the unfortunate answer is yes. We are going to see inflation rise again, most likely to 8.8% year over year. That's a 40-year high, highest since 1982. And just for some context, before we got into this period of inflation, normally the CPI would be running around 2%. Now, 8.8%, maybe even 9%. So it's quite a spike.
So I watched, all these business channels, and there's a sort of fast and furious argument about whether we're headed into a recession, whether we're already in a recession, but we don't know it. Economists are going to be watching the Treasury yields right now to indicate a possible future recession. Can you just explain what exactly the Treasury yields are, and how would they be having an impact on whether or not we are headed towards a recession?
So Treasury yields are just the current interest that the government pays on U.S. government bonds. And if investors think there's a lot of inflation, those yields will go up. And if they think there's going to be a recession, yields will go down. Right now, yields are up. They're at multi-year highs. And here's why this matters to your viewers. It makes life more expensive, which is the last thing we need, right? So Treasury yields, high Treasury yields make auto loans, mortgages, refis, all more expensive, and perhaps most importantly to everybody, credit card rates. So it's just kind of compounding this inflation and this squeeze we're all feeling right now. Regarding the inflation, it's very hard to tell, but I think that the practical advice for everybody out there is just be prepared for a slowdown. Whether it's a recession or whether it's not, folks, the economy is going to slow.
Yeah, a lot of people got some extra money during the pandemic. Some people really needed it. Other people did pay down their credit cards. It's a good idea just to sort of stay in that mode. Just be conservative as we wait for what's coming down the pike. Tom Essay, thank you very much.
Thank you.